This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have David back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over David's picture saying, looking for the downloads. Okay, Eric, let's start off with your thoughts here on the equity markets.
Well, Patrick, my June hedges have expired, so I'm starting to accumulate September put spreads on S&P E-mini futures, but not too aggressively here. I think they're going to get cheaper before they get more expensive, so I'm taking my time starting to accumulate and build a position.
Eric, we continue to be at a really interesting moment in the markets here. We are now directly retesting those December, January, February highs up around the 6,100 area. Now, to accompany that, we basically had a straight line rally from the April lows up 27% in a span of like 75 days. And so this market is overstretched. Now, one thing that is becoming an inherent feature of markets is the direct influence of flows, particularly by systematic money. Recently, there's been huge flows on vol targeting funds that are doing substantial buying driven by contracting real volatility. At the same time, we've had CTAs all have to do the bullish flip on the upside, and dealers, which were long a whole bunch of gamma, were actually forced to pin and drive this market higher toward that pin, and now kind of influencing this short-term market direction. The point that I want to highlight is that all of these forces have now stretched this market and are now, like David was suggesting, trading at some pretty high multiples in an environment where we really now need a whole bunch of very positive news in order for the market to stay up here. We could have a jobs numbers disappoint next week. We could have some tariff issues. And later in July, we could have disappointed earnings that don't meet up to these lofty expectations. There's a lot of things that are in play, and the market trading up along these highs in an overbought condition, including the fact that we're now 250 S&P points above the 50-day moving average, which is about as far as it typically goes before beginning some sort of a correction. We're in a window where the asymmetry is skewed against the bulls on the short term. Now, that doesn't mean it has to be an ominous market drop like what we saw back in March and April. Not necessarily, but a correction is long overdue here. Even a 5% correction is 300 plus S&P points that could see us trading down to 5,800 or even a little bit lower on a very quick reversion. At this stage, I think that you have to be planning for at least some form of a correction, and things really could get very toppy here throughout the summer. All right, Eric, let's touch on that US dollar.
Well, Patrick, the breakdown that we've seen this week to fresh lows below 97, trading at a 96 handle at recording time, just confirms our predictions here on MacroVoices that a new secular downtrend is in play for the US dollar. And frankly, I think we could have a long way left to go to the downside.
Well, on page 3, I have that US dollar index chart, and we can really see those lows that were established in 2023 and 24 were not only decisively broken, but became resistance when the market tried to rally last month. We've seen over the last month is incredibly negative price distribution. Every rally has almost immediately failed, as this is clearly in this decline of lower highs, lower lows, and it persistently being hit on the bid. While we're seeing some currencies like the US dollar, yen, far more in a muddle, there's very clear trend in the euro, pound, and the Canadian dollar as an example. And so we find ourselves in a situation where this breakdown to a lower low has in fact put to bed this idea that we could have a support line or a double bottom along the previous low. And so the question is, how low does it go? Well, first, the most immediate downside target is this 95 to 96 zone below, another couple handles down where there's a measured move. But if we really zoom out on the weekly and monthly charts, there was this pronounced trade range that was established through 2016 all the way through 2021 for over 5 years, where the bottom of the trade range was all the way down at the 90 level on the Dixie, and the upper boundary range was this 100 to 102. And so if the fact that we've broken down, now is the question is, are we now re-entering that trade range? Are we now vulnerable for seeing the dollar index go all the way down to 90? Well, that's certainly on the table, because with this breakdown, the distribution is so relentless. Even though the dollar's a bit oversold, it's a clear trend that is in place, and we want to first see where it settles down before trying to rock star call a turning point in the dollar. All right, Eric, let's talk oil.
Well, Patrick, you got to ask yourself, is this sell-off that we've just had of $10 from more than $10 from $14 from the highs, is this a second chance to get in on an opportunity, to get in on the long side of a new oil rally that could have legs? Well, clearly, we've just seen a pretty violent reversal to the downside. But the question to ask yourself is, why did we see that reversal to the downside? Well, it was because President Trump said problem totally solved, and now all nuclear facilities, all nuclear enrichment capabilities, centrifuges and so forth have been completely and totally obliterated and destroyed, according to President Trump and precisely nobody else. Sorry to be blunt here, folks, but I think this really is as simple as I don't think the president understands, or maybe it's just people around him are telling him what they think he wants to hear. But I don't think he gets it. I don't think he realizes that most analysts, everybody other than himself, is saying they didn't do that much damage. The bunker busters didn't really destroy all the nuclear facilities as hoped, and it probably would only be a few weeks to get them restarted again. Well, okay, if that's what happened, when President Trump does figure it out, he's probably going to get aggressive again. And what we've just seen is $14 of risk premium come out of this oil market because President Trump calmed down. Why would we think this is the last time President Trump is going to get uncalm and potentially do something aggressive again? Seems to me like there's an awfully good chance that we see another big upward price spike in oil if we get another round of this. And that seems extremely likely, especially considering that nobody else, including the folks that read the bomb damage assessments, agree with the president's view that everything has already been neutralized. He actually said that there would be no need in talks with Iran to even negotiate a new nuclear deal because there was nothing to negotiate. There's no more nuclear risk to worry about because it's all been obliterated. Nobody else thinks that that's true. So when President Trump figures out that it's not true, I think he's going to do something that's going to take oil back up. So I think it's potentially, at least if you're in a speculative mood, a bargain buying opportunity here to get in on this long. Patrick, what's your take on it based on the charts?
Well, maximum volatility is definitely what we're seeing. And there was a huge risk premium being put into oil, and the fears that the escalation was going to draw the U.S. deep into this confrontation. And that was very rapidly withdrawn out of the market earlier this week. We now are trading at a very interesting moment. The $64, $65 level on WTI is, in my mind, a kind of key pivot, because if we're on a sustained basis, not only below the 50-day moving average, but below this retracement zone, then the only outcome is crude oil going for a direct retest of April and May lows, which are all the way in the 57 and 60 level. And the question really is while maybe the escalation of the situation isn't that severe, alternative point is that is oil in that kind of abundance that we could see, in spite of all of these conditions, oil trading right back to its previous lows. My view here is that it's a buy on dip. I don't think we're going to see, at least we're currently betting that we're not going to see that 57 to 60 zone, and that this level will actually hold. Now, does that mean I think oil is going to 80, 85? Well, I mean, a lot of things would have to start kind of working in oil's favor for that kind of move. But a bounce back to $70 and us re-engage a new trade range where we spent September through January trading in a kind of like $68 to $72 range, I totally think we can get up there and see a new elevated level for crude. So I'm buying here, looking for that kind of a bounce up to that zone. Eric, on page 5, I have that gold chart. It continues to consolidate, but well above that 50-day moving average. Are you still bullish here?
Well, Patrick, it makes perfect sense that we've had this deep dip or pullback or correction or whatever you want to call it, this $100 down in gold price makes perfect sense for the same reasons that oil is selling off hard. The world has been told now that nuclear holocaust was just averted. Everything is fine. Iran nuclear facilities have all been destroyed. There's no more tension or grief between the U.S. and Iran. Okay, I think when President Trump figures out that the nuclear facilities were not really destroyed, that's all going to change. But for now, it makes perfect sense that if the theme that's driving other markets is a perception that this is all blown over, we saw $14 come out of oil, we saw $100 come out of gold. I think we're going to see both of them go back up. So buying both of those dips makes perfect sense. So far, the low on gold intraday has been 3308 on the August contract. I know that number all too well because I only missed it by almost exactly $5 on my resting limit order below the market, which didn't get filled today. I think I still have a shot, though. The slow stochastics are only just starting to touch the oversold range. The RSI is still mid-range. So I think there's definitely room for another small wave down here, maybe to, a high 32 something, 32.90, 32.93 in there somewhere, maybe where I think the bottom is. I'm still going to buy just above 3,300 on this dip if I can get it. And one way or another, I'll buy this dip. If it turns out I already missed the low, I'll chase it if I have to in order to get a seat at this table.
Yeah, Eric, I'm in the buy on dip camp as well. At this moment, we have U.S. dollar weakness, which typically is a tailwind for gold that is priced in U.S. dollars. And at the same time, almost all these pullbacks have held above its moving averages, held above fib zones, making it a very traditional consolidation. Now, at any one point, gold could start a bigger correction, but there's no reason at this moment from a price action perspective to believe that has begun. And therefore, I'm in your camp that dips should be bought, and there's room for this still to break out. The first wave measured move is towards that 36 to 3,700 if it does break out. So we're watching whether this important 3,300 pivot ends up holding the line here. So Eric, let's talk uranium. On page 6, I have that Sprott Physical Uranium Trust, and prices have clearly been improving. What are your thoughts here?
Patrick, the spot price of uranium, I've said many times, is the key. Once that gets moving, everything else will follow. And that's exactly what's happening. Spot uranium is $77.50 now, almost at parity with $80 term price of uranium, the contract price for long-term contracting of uranium, which is where all the volume happens in the uranium market. Now, unfortunately, the gap-filling pullback on uranium miners that I was hoping for is is probably much less likely to happen at this point. Seems like it's kind of game on for this bull market. And now that spot uranium is moving to the upside, it seems like it's everything we can just to hold our horses. So I'm still hoping that from a seasonality perspective, this market shouldn't really heat up until September. I'm still waiting for a nice big dip to buy. But if we don't get one by mid-August and I haven't gotten my full allocation on a dip, then I'll buy at whatever price I have to in order to hit my max leverage target before we get to Labor Day, by which I mean American Labor Day, 1st of September. I think it's around September that seasonality, and right after the WNA conference, which I think this year is the first week of September, right after that conference is when the buyers usually really start buying, and I definitely want to be at my max leverage when that happens.
Well, Eric, of course, buying dips is always better than buying rips. But I think the bigger thing that I want to highlight is the fact that we had a very clear and pronounced bear market in uranium, where from January of 2024, when it peaked, we basically spent 15 months in a very clear distribution cycle that saw uranium virtually lose 50% of its value based on that Sprott Physical Uranium Trust. Now, that sequence of lower highs and lower lows in that downwards channel has finally been broken, and we've now spent over a month and a half in a bull trend above the 50-day moving average. This is the very distinctly different price action than we've seen in the year prior. And so to me, there's a lot of evidence that uranium has obviously entered a new bull phase. Buying dips is clearly the more tactical way of approaching it. But I do believe that these are still the very beginning phases of a bull run that could last the rest of the year and even a chunk of next year. And so continue to watch whether uranium can build on this is 100% on my watch list.
Patrick, before we close, let's hit that 10-year Treasury yield. What are the charts telling you?
The 10-year Treasury yield off of its May high near 460 has now dropped down to 428. So we're seeing yields slightly weakening on the downside, rolling over. The big question, are bonds bottoming, and are we going to see a rip in the bond markets, or is this just a retracement from a interest rate market that is simply not ready to make higher yields at these levels? I'm relatively more neutral on the 10 and the 30-year bond at this moment. There's plenty of room for them to be bottoming. David Rosenberg was talking about the idea that there's a very much asymmetry in owning these treasuries down along these levels. But the question is that have we really seen the beginning of this trend move? And that is still very premature to make that call. But where I have higher conviction continues to be on page 8 when I'm looking at that 3-month SOFR futures. Particularly, I'm going out to December of 2026, 18 months forward. And this is where I find it really interesting because there's so many dynamics that could potentially have the Fed be forced to cut more interest rates than are currently being priced in. It could be the announcement of a much more dovish Fed chairman next year. It could be the inflation continues to be benign, or a recession rears its ugly head. Whichever the catalyst, to me, I don't see much downside risk on this, and I see obviously all sorts of surprise risks that could actually have this thing rocket 100 basis points. Continue to still really like this as a new trading opportunity.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests, and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.